Awesome. Thank you, ladies, for joining. As I was saying, so we'll keep it short. We'll keep it very. I'll try to make it very interactive. Please feel free to ask any questions anytime. If you have, just raise your hands. Otherwise, yeah, I'll get started. Right. So I'm gonna focus on three things today. First is why should we do investing? Second is how much should we invest for? So like when I started, I was always like jittery about okay what percentage of like my income should I invest in, and third question that we're going to answer is how and where, like the most important part, right? So I'll start with the first why, right? So there's a like there are hundreds and hundreds of quotes from Warren Buffett and the likes, but in general I think one which strikes the best with me is let your money work for you. When your money can earn you more money, what's not in it to like, right? So it's very simple that you have whenever you have some cash which is lying around in a current account, you can make smart investments on top of it and let your money work for you to invest a little bit higher. Yeah. Next is how much. So again, I'll take some inspiration from our initial, like very simple fundas that have been going on in the market forever. So whenever you're thinking about investing and like what portion, just think of it in this way. Whatever your in-hand income is, divide it into three parts. It's a very simple 50-30-20 rule. The first 50% goes to your needs, which is your rental expenses, your food and the likes. The next 30% goes to your wants. Of course, why are you even earning that money for, right? The new Louis Vuitton bag you have been eyeing for, and the likes, right? And the last 20% is when you should definitely consider savings and investments, right? Now, in this 20%, where can you invest? There are many ways in which you can invest. So, as you can see, of course, even the cash lying in your bank account earns you a little percentage. That's also a form of savings. I would not call it an investment, but some sort of saving. Then there's fixed income, which is debt instruments, government, companies take money, take loan from your money so that you can get an interest out of it, a coupon, right? We'll not deep dive into it a lot. Next is real estate. Not my cup of tea, but yeah, like people, it's a very big asset class in general. I think one of the biggest in the world. Again, not something that we'll deep dive into today. And the last two are equities and digital assets. Equities is simple: stocks, shares, etc. We'll discuss this one in a bit more detail. And last is the digital assets, the new hype in the world, we call the cryptocurrencies and the like, right? So this is the lower you go on this, right? So there's a very famous saying in finance: higher the risk, higher the return. So imagine every sort of just imagine it in a form of a price chart, right? So if something is going moving like this, there's low risk because it's in a certain band, it will not lose you a lot of money, but there's a lower return associated with it as well, right? So fixed income, the interest you're getting is also smaller, but the risk associated is also smaller. Whereas digital assets, the price movements are higher, they go a lot away from mean, but at the same time, they have the probability to give you higher return, and at the same time are the more riskier assets, right? So just remember every time that higher the risk, higher the return, no pain, no gain. Simple, right? So that's the basic funda. I just want to keep it like very light. So hope that's not an issue. Cool. Moving forward, how do you think about, okay, so now let's suppose we have, I don't know, like let's suppose I am assuming a person who has 100K as in hand income, 20% of it is 20K, right? How do you distribute this 20K? How do I think of it? Is very simple. First and foremost is a safety net, especially in this volatile era of COVID and wars happening. I think one of the most important thing that people have realized is that everyone needs a safety net. So just think about keeping a separate net of 3 to 6 months of your salary, which can sustain you long enough before you, I, I mean, like find a new job or something like that. So yeah, this is your safety net that can cover you in difficult times. Usually for everyone, it's enough to keep 3 to 6 months of salary. Next, how I think about it is like let's take some risky bets. Let's enjoy with it, right? So yeah, 5 to 15% again varies from like what sort of like it really depends from person to person. Usually people save like 10%, and that's basically people take risky bets on new and upcoming assets such as digital assets or and the like, right? So cryptocurrencies, when you can think about like keeping like 10% of your annual income each year in cryptocurrencies, and the rest is like usually this is what people do, of course to each his own, but rest is what people divided into real estate and equities, right? Of course we're going to focus on equities a lot more today. So when you think about equities, I'll start with the very basic, like what is equity, like what are we talking about, right? So I'll start with the basic question: what is a stock? Imagine there's a company and the ownership of a company's paper. That paper is being cut into million parts, and each part is called a share. That's it. Basically, when you own that 1 millionth of a paper, you own the ownership. You have the ownership in that company. The profits as well as the losses of that company belong to you. That's it. So you have a house, you have the ownership of a house. Simple, right? That's what you call an asset. Similarly, there's a company, 100% is divided into millions and millions of people, and the smallest unit is called a share, and that's where that when you buy in a stock, you own that smallest part of a company, right? And yeah, of course, like with like stock trading has been going on forever and for now, right? So that's why people have now developed more sophisticated way of changing the ownership of stock. You can buy from me, I can buy from the other girl on the call, right? So there are like sophisticated digital exchanges on which you can transfer the ownership of that small portion of that company from one person to another, and that's how you sort of trade. That's very basic stock trading. Now what is in it for me to buy a stock? Why do even people buy a stock, right? There's sort of two ways more or less, right? One is the price movement. I bought a stock at X, it goes to Y. Now the Y can be greater or lower. There can be a gain or loss in buying a stock, right? So that's when you sort of make money or lose money. That's one way. And second is more or less many companies, not the newest technology companies, but they issue dividends, like just as like thank you for your ownership. This is the extra income that we have this year. This is the dividend. So these are the more or less two reasons why people buy stock, right? So we just wanted to cover the basic. I think we're all set. Let me know in case you have any question. Otherwise, we'll deep dive into the interesting stuff. Yeah, awesome. I will.
Yeah, I don't see any questions, so I think we can continue.
Cool. Awesome. All right. So now we are clear on okay, what is a stock? How do people buy stock? Why do people buy stock? Now let's look at okay, what are the different ways in which I can get exposure to like this equity or the ownership of a company, right? So one is of course just buying and selling stock is one way. Second is more riskier way called derivatives, where you bet on okay, what could be the price of the stock, right? So those are different ways, futures, options, etc. We'll not get into this today. Second is okay, so uh, think of investing in two ways. One is active investing, where you sort of go ahead and research each and every company and then you invest in a single company. Second type is passive investing, where you think about, okay, I do not know where this company or that company will go, but I have a long term view on, okay, where the US market will do better in the next 10 years, right? That's when you invest in more broader funds called ETFs. ETFs is nothing but a collection of hundreds, 500 units of share, like different companies clubbed together. I do not want to do active investing. I do not want to do research. I just want to earn whatever the market is giving me, right? So these are the two types of investing. Here, if you see, first two methods, these are the way to invest actively. Whereas these are like ETFs, which are exchange traded instruments. We'll talk about these later, mutual funds. These are the instruments in which you can take a view on a market or a sector or a geography. I am interested in robotics China. It will grow a lot in the next few years. So you can buy an ETF of robotics in China, right? So on and so forth. You don't need to do particular research about finding a company. Yeah. So these are various way into in which people invest. We will look at a very high level into both of these today. I will first start with stocks. Like I'll just take you through an exercise which, like, usually me and like a few of my colleagues, we do to sort of identify stocks for our long-term investment. We can do it together. Yeah.
And we have
So
a question. How to find which companies gives a dividend?
yeah, sure. Let me. So basically, okay. So to help us, um, there are various instruments, but yeah, this is called a screener. Very typical. What you can do is just I'll just write it in the chat over here. You can just so this is a trading view. It's a very heavily used research uh, tool for stocks trading. You can just have a look at it. Here you'll be able to find okay which of the so right now I've set the geography to US. You can set it to whichever market you want. Here you can go and find okay I want to see which company gives dividend, right? So yeah, you'll be able to see in the last 1 year which company has given dividend and of what value. Yeah. Does that answer your question? Cool. All right. So yeah, going back to what are the different factors that we can consider while investing in a stock. Again, I'll just keep referring to that tool. If you guys have your laptops handy, just please feel free to visit it. So whenever I think about investing in a stock, right? First of all, like you start with the bigger funnel. I have like, I don't know, in each geography, thousands and thousands of stock. That's where we start from. And then we narrow it down to probably a set of like a few couple of companies, right? So the initial first cut that you have to make is on the macro environment. Which geography or which region do you think that you want to invest in? It could very well be the geography that you're living in, or it could very well be that you think that US market or probably say China market is going to do better. You can choose. But yeah, in general, China market riskier, US market more safer. That's how people look at it based on their own risk appetite. Right? That's the first cut. Second cut is industry sector. Again, this is optional. Some people have very strong views on COVID has hit, pharma is going to do well, so I'm only going to invest in pharma for now. But again, it's a very subjective filter. I usually am not a big fan of this. People can take their own calls on this, right? Next and most important part is fundamental of a stock. So usually, and again in finance, there's a saying, history repeats itself. What we do is we look at historical fundamentals of a company, how historically well it has been performing, and based on that, we take a call that okay, in the future also we expect that the company will do better, right? Most important fundamentals that like most people, again everyone has their own heuristics, but most people look at are these. I'll go through these one by one. First is market cap. So just again think of it this way: smaller the company, the probability of them making bigger is again higher, but at the same time probability of them going bust is also higher. So smaller the company, higher the risk. Larger the company, Apple, as like 2008, we used to call, like, basically it's too big to fail. Like Apple as a company is less riskier investment than say supposedly a new genome research company, right? So usually people have their own preferences. Somebody wants to make it big or go home. They can invest in smaller companies, or they can invest in say like mega cap companies, Apple, Tesla, etc. Right? So what we'll do is very simple. We'll go to the screen called Stock Screener. We'll add a column here. So this is like I'm not sure if you guys are able to see it, but yeah, this is a very simple, easy to use tool for all the companies in US. They have collected all the data and put it here for us. They have literally hundreds and hundreds of variables on which you can observe the companies. You can just go here, either put in filters, or you can just add more columns over here so that you can look at each and every data point, right? So I'll start first with market capitalization. Yeah. So I'll simply, like, what I do is whenever I don't know about a geography, what I do is I'll just sort, look at the top 25 percentile, right? For now, I'll just take a guess. Okay, I'm only interested in companies between 500 million, right? So yeah, this is the list of companies. So basically, as I was saying, that it's a funnel. We are going from a very big, like, 5,000 companies to a smaller companies. This funnel has sort of reduced to one step. We have taken a market cap field. So usually how I do is I'll just look at top 25 percentile. We can do the maths here and just choose, okay, which companies are we interested in, right? So, okay, we've got to a smaller list. Next, market capitalization. Sorry if I've not introduced, but it's basically directly related to the size of the company, that is, volume of the shares that is being traded on the stock market. The larger the company, larger the market cap, and lesser the risk, right? So, first factor is market cap. Second is ROE, return on equity. Again, very simple factor, ROE and ROIC both. The ROE is in the last 1 year, 2 year, whatever time frame. What is the return that the company has made on the equity value? So, if let's suppose the equity value of the company, including all the assets, and, like, I don't know, I have a house, I have invested 1 million in it. In the last 1 year, what is the rental yield I have earned on that 1 million? Very simple, like to like comparison. That is called return on equity. Like, if there's, like, whatever portion of the equities in the last 1 year, what is the return that the company has earned, right? Again, we'll just go to the stock screener, add it as a filter. Hmm, here we are. In this also, I usually, what I do is, return on equity is higher than the 25% value. For now, I'll just put in 30. Yeah. Next is ROIC. ROIC is also a very similar factor, which is like, similar to ROE. ROIC is return on invested capital. So let's suppose in the last 5 years, a company has opened a new plant and have employed 500 grants for opening that new plant. How has that new invested capital given the results in the last, like, same duration, is what ROIC measured. So basically it measures that how smartly the founders or the operators of the companies employing their capital. How smartly are they making use of the extra money that they are investing in the company, right? Again, what we can do is go here, simple exercise. We can just add this filter. Top 25% in each market. For now, I just go with 30. Next is revenue growth. So all of these factors, as I mentioned earlier, like history repeats itself. What we are looking for is, if the company is big enough and they have been returning enough value, creating enough value out of the money that they have invested in, and they have been consistently growing in the past, is what we expect the company to do in the future as well. So, one, they have utilized or, like, put in their money smartly. Second, it's not like, okay, one shot they grew and after that they have been flat. They've had a consistent growth over the years is the next factor that people look for, right? So again, historically, companies have done better. Like, the growth has been linear or exponential. Good growth is what you should look for. So I'll just put in growth, and there are like 100 factors, but usually, like, whenever you're thinking about long term, you should think about like annual rather than quarterly. So annual EBITDA growth, and then I'll also look at, say, sales growth as well. So revenue, annual YOY growth. Again, what I'll do is I'll apply the same filters as to, like, these companies should have more than, I don't know, 50% or like 30% growth, we can just resort back to the basic fundamental to top 20 percentile, and that varies from each market, 25 percentile. So now, like with the universe, sorry, yeah, the universe, which was of like multiple thousands of companies, has come down to, oh shit, I lost all of those filters. I am so sorry. But yeah, you got the gist, right? So basically, what we do is we start with like 5,000 companies, and then we narrow it down using these filters. And then after, so once we have looked at the fundamental of the company, okay, the company is doing strong. Historically, it has a proven track record of using money smartly, of delivering growth year on year. Like the fundamentals are sound. Next thing that you do is like very simple, right? You go and like you buy an iPhone. You historically look, okay, iPhone has been doing innovative thing over and over. Okay, I want to buy an iPhone. Next thing is, of course, you look at price. Is the stock that I'm trying to buy is priced right or not, right? If it is overpriced, I would like to sort of wait, or just have a quick comparison. If there are like five companies which have passed all of these fundamental filters, out of this I would like to invest in a company which is most sort of underpriced in the market currently, right? And one way to look at it is PE ratio. So price to earning ratio. It's again, it's a indicator that is used to sort of compare companies. So if one company has lower price, so price, I don't know, 100 divided by earnings. If same company is trading at a lower value and earning more, I would like to invest more in that company. So lower the PE ratio, better. So next filter I'll apply is price to earning ratio, and I'll just like sort of sort on the basis of this, look at the company with the lowest P ratio, and out of that sub like in would like to invest in the company with the lowest P ratio, right? So these are the things that you usually look at from a fundamental perspective and from a price comparison, right? Between a Android and iPhone. Yes, it is giving me a better feature, but at the same time, is it very much overpriced? Then I would not invest in it, right? Next, before investing in any company, what I do is I just do a very basic news research. So just to check if there are any red flags for the company, right? In the past year or so, just go to Google, search about like this XYZ Tesla stock, and then news in the last few years, important news. And if I see any bad news about specifically the management, or say like I don't know, there was some planned with like leaks and all, so I would like to stay away from those sort of companies, right? That's just one basic qualitative check that we can perform. After that, what I do is essentially just look at the revenue graph. It should never be like usually seasonality is one thing, but if the company graph in terms of revenues and profits have been a very zigzag, I would not like to sort of invest in those companies, because again, like it does, I don't know about my investment horizon as of now. So I would like to invest in companies which have been stable and have been growing in the past few years. So yeah, these are the basic things that like can give you a starter as to like a basic thing that you can do on your own when you want to start researching companies and invest in those. I'll take a quick pause here for any questions or thoughts. Girls, am I making sense?
No questions yet.
Awesome. Cool. So yeah, awesome. Thanks, LD. Thanks. All right. So yeah, this is how you sort of, so of course, like if someone is new to investing, what they can do is just dabble with $50 or so. Just start with one company. You can use these filters to invest, and then probably as we go along the way, we can learn more. Right. This is how you sort of think about investing in one particular stock, right? You can just use these filters and buy. Now, this is more active investing where you do your research, you find a company, one single company, and you invest in that. Another way for getting exposure to equities market is through passive investing. Or basically, very simply put, I don't have the time or the patience to do the research. I want to take a look at the macro market, whatever markets at a very high level earning, I am satisfied with that. I don't want to earn more than markets, right? So just take an example of FTSE 100, right? That is like howsoever market is doing, I'm happy earning the same return. I don't want to do the research. Then this is the way for you to go. There are multiple ways. Like you can invest in an exchange traded fund, you can invest in a mutual fund, or you can do robo investing, such as Nutmeg. But that's on you to choose. But the easiest way to get an exposure to a market is ETF. I won't say easiest, but it's basically the most cost effective way. And hence, for session today, I'm going to focus on ETF next. Right. So again, the research to find an ETF is not as thorough to find a stock, but then there are some things that you should just sort of look in an ETF when you're investing. And again, we have like somebody has done the dirty work for us. They have created this cool tool called ETF screener. So what you can do is I will quickly type it in the chat. Yeah. All right. Awesome. So what we'll do is very simply just play with this again, similarly that we did with stock screener. Uh, the factors that you consider while investing in ETF. Just imagine that this is like when stock is basically investing in single stock. This is a macro view, right? You are investing in a geography, a theme. So whenever you're looking, first you decide, okay, which asset class you want to take, right? So as we discussed before, there are fixed income bonds, there's equities, there's real estate. So we'll today let's start with equities first. So like for now, let's only start with equities. We'll not go into market capitalization for now. So first thing is, okay, I want to do investing in equities. Second thing you decide is geography. Again, there's no single rule of thumb for to each his own. Like you can think of, if you want to get into more riskier asset, think of investing in India and China. When you're thinking of more stable, you can think of developed markets such as US and Europe. Of course, like wherever you stay, you can think of that way also. I want to like I'm bullish on like this country will do better, right? So for now, let's start with US, right? So here you can go to a region, you can select a region, right? Next, any theme or sector that you are interested in. Again, it's an optional filter, not for everyone like to choose, but yeah, there are some people who have very thematic view. I'll also share a list of all the themes that more and more people are looking at these days. But yeah, I have a view that companies producing electric vehicles will do better in the next 10 years, or I have a view that companies dabbling in genome research will do better, right? So it depends on what you want to invest in. I'll share this link later, but yeah, that's basically a exhaustive list of themes that you might be interested in. So yeah, these are the two few things that you look at. And then one important thing similar to market cap was, sorry, 1 second. Yeah, total size of assets. So again, smaller the size of assets that an ETF has, higher the probability of it being more risky. So we will try and like sort of restrict ourselves to the higher, like the top more liquid end. So it's easier for you to buy and sell as well. So just imagine if more and more volume of the same ETF is available, more and more buyers will be there, and you will be able to sell and buy at like less arbitrage is there, right? So we'll try and restrict to the, so if people like depends on your risk profile, but if you're like slightly cautious, just try and stick to the later part of this horizon. Yeah. and then a few things. So yeah, this basically gives you, okay, I want to invest in US stock market, right, at a very high level. You can also choose, okay, I want to only invest in mega cap and large cap, right? I'm only invested in, say, sort of the Teslas of the world. I don't care about the smaller companies. So this gives you a list of, okay, these are the four ETFs available. Now, how do you choose between these four ETFs? So it depends on how much it's going to cost you. So that's also one important factor with ETFs. So each ETF comes with an expense ratio that will be deducted from your own investment. So if you invested $100, and let's suppose an ETF has a 0.03% of expense ratio, they will each year deduct that 0.03% of your $100. So you would want that to be the smaller amount. So in that, you will just go to expenses and you will see, okay, which one are the cheaper ones, right? I would like to invest in those. So I'll be more interested in these three. Now, if I'm not able to choose between these three, I can use another filters, which are, say, liquidity and, sorry, just one more, which is around tracking error. I am not able to find it in this filter, but yeah, basically you just look at, okay, which are the cheaper ones and which has the higher assets. So between these three are very comparable, to be honest. But yeah, like probably I'll be more interested in IVV, like the iShares one, because it has more assets. To be honest, these three are very comparable. You can invest in any one of these, right? So this is how you choose an ETF. You just think about, okay, this is the country. uh, think about or do your research. Okay, I am not a very risky investor. I would want to invest in large cap and mega cap. uh, Again, not a risky investor, and hence I would like to stick with very high assets. And then you can take a call on the country and then choose an ETF based on the expense ratio. Yeah. Again, I'll just take a quick pause here to see if there's any questions.
Yeah, there are a lot of questions right now.
All
Um,
right.
so the first one, I think, how do you decide when to sell your stocks?
That's a very, very interesting question. I think I get it every time. But just to quote Warren Buffett, he says never. His answer is never sell your stocks. But I'll give you like the realistic answer. So usually, how people do is they do a goal based investing, right? So like I'll just take my example. I have a so long term portfolio, which is more from a retirement perspective, more from a like college fund of children perspective, right? Just taking an example here. And then I have a short term portfolio, which is like I want to buy my own house in the next 5 to 10 years. So that's how I see my two pots of investment. And that's how I put my stocks in. If I have a stock which is like not really like a short term view, which is like, okay, Tesla is gonna do great forever, I'll just keep it in my long term pot. And then I have a view, okay, COVID has happened, pharma is doing good. That kind of a view, tactical view, I'll keep it in my short term pot. And then I'll look at, okay, historically, what has the sector gained, and like that's how you sort of first segregate your short term and long term. Now within your short term, the turnover again should be somewhere around 3 to 5 years, or of course depending on your needs, plus what is the maximum return that a stock has had in this sector in the past few years, is what you can look at as a benchmark. If your stock return hits somewhere close to that, that's when you can liquidate, right? No science, more art, for sure. Short answer, just think of your pot into separate your pot into two part: goal based investing, long term pot and short term pot. Short term pot, you can just look at, okay, historically what has been the return in the sector. Am I hitting like probably plus 5 plus minus 5%? That's where you can liquidate, depends on your needs. Yeah.
Yeah, I think, yeah, I hope that is the answer. Yeah. Um, yeah, I will add at the end my thoughts. Um, so, would you recommend investing in more than one stock?
For sure, like undoubtedly, diversification. like nobody can stress enough on this. Like diversification is the way to go. Even if a company is too big to fail, Apple tomorrow, you don't know, some company comes up and make Apple redundant in the world, right? So I won't say that like have like 100 stocks in your portfolio. If that's the case, go for passive investing. But yeah, otherwise, at least a 10 to 20 is a decent enough size number of stocks that I have seen in people, like various people's portfolio. Like never rely on one stock for sure.
Yeah, thank you. Uh, what proportion of active passive investment do you recommend? I think you mentioned in the beginning.
Yeah, so within active versus passive, I would say it depends on your knowledge and depends on how much time you have to invest as well, other than just like the basic financial fundamentals. But yeah, it depends on how much time you can separate for active investing. At the same time, I think there's no fixed rule, okay, 50-50. But yeah, like I personally, what I do is again, like the long pot, the long term pot that has like 60-70% of passive investment, 30% active. Where short term pot, it's more active. It's the reverse, 70% active and 30% passive. But yeah, it all depends on your interests in trading. If you do not want to dabble into it, go for passive investment 100%.
Okay, good. Very interesting question. How do you decide your risk appetite?
Sure. A few ways to go about it. First and foremost, I think there are many tests. You can just go to Schwab website. I can just text a few links. So basically, there are set of questionnaire which people ask you, and they can give you the answer. But yeah, in general, I think even like when you are deciding your risk appetite, think about your goals first, where you want to invest for, and like what are you saving this money for, and like how long is the most important question. If you do not want to touch this money for next 10, 15, 20 years, then you can be as aggressive as you want. But if you have some long short term goals, then create a separate port and like make it less risky. So it all comes down to when will you need that money again, very simply put. But yeah, in general, there are a few websites that you can visit, and they'll ask you a bunch of questions, probably 15, 20 questions, and they can help you determine your risk appetite. In UK, there's an interesting one called Nutmeg, which you can use. Probably just go and sign up. They'll take you through a questionnaire, and then they'll recommend you a risk profile as well.
Thank you. That's very good answer. The next one, what trading platform do you recommend?
I can't ditch my own brand right now. I am from Revolut. I have not used that name since the beginning, but sorry, I am a loyalist. But yeah, in general, in UK, I would say there are a lot of options. Free trade, there is trading 212, there is for passive investing, Nutmeg is there for sure, Wealthify is there. So yeah, for active, Revolut, free trade, and trading 212. For passive investing, Nutmeg and Wealthify is what I have seen doing the best. But yeah, there are a lot of websites which compare trading platforms. Most important, of course, is the cost that they take. Take that into account while making that decision.
Thank you. The next one, I'm not sure I understand it, but I will try to just say the same. What
But
you recommend? Would you recommend going down the stocks and shares ICA route?
for sure, like undoubtedly. So basically, stocks and share ISA is essentially any income that you generate is taxable, right? And if you do not invest through ISA, you pay, I don't know the exact percentage, but in all countries, there's a 10 to 15% tax that you have to pay on that income that you generate from your stocks investments, right? Now, government, to promote stocks and share investments, they have introduced ISAs. You do not pay any tax on that income. So first, like before even going ahead and opening a GIA, which is a taxable account, ensure that you fulfill your recommendation for like fulfill your quota for ISA. Again, think about most of the platforms charge a lot of fee for ISAs just because of the fact that they are tax free. Just choose your platform wisely, exhaust your ISA's limit first, and then think about investing in GIA.
Yeah, it's a very good answer. Thank you so much. Yeah, I think it's all
Awesome.
right now.
Perfect. I think, yeah, I I can go ahead and like talk about other forms of investing, but I think we do not have enough time to sort of go through that. I'll be happy to answer if there are any other questions. Yeah.
I think we can continue actually.
Okay.
Uh,
Awesome. No worries. All right. So yeah, after ETFs, so ETFs, as I was talking, there are various ways in which you can invest passively. One way is, of course, ETFs. ETFs is nothing but exchange traded funds. They have had a collection of, sorry, there's someone at the door. Yeah. So ETF is nothing but probably a collection of hundreds of stocks into one single unit that is being traded on exchange. However, there are other ways in which what you can do is essentially just give away this responsibility of investing to some people who are smart at it. So that's called mutual funds. Mutual funds is basically there is an active investor sitting on the back who is deciding which stocks to buy, right? Now the difference, and they also try to be quite diversified in terms of like 50, 100 stocks per mutual fund. uh, the difference is, of course, because there's a human cost involved. The mutual funds are more expensive, slightly more expensive than ETFs. But yeah, depends on what sort of returns that they can earn. So again, like we can do the same sort of research for mutual funds that we did for ETFs. It depends. So basically, if you are willing to sort of part away with 2 to 3% of extra cost in expectation of earning more returns, that's when you sort of go ahead with mutual funds. They are more nuanced, and then there are a few factors that you should look at it as when compared to ETF. Other things are same. One thing is past performance. Do check their CAGR. CAGR is compounded annual growth rate in the past few years, like at least 5 to 10 years is what you should check before investing in these mutual funds. Another very important thing is quality of management. So we should definitely do some research about. So one fund manager is usually involved in like multiple funds. So you should definitely do thorough research on how has this particular fund manager been performing with other funds as well, and that's when you should invest. And then there are other clawbacks and exit loads. So you should definitely check if there are any sort of buried TNCs or exit load associated with the mutual fund. Usually, what mutual funds do is if you sort of exit the security before any year, they charge you an exit load. Just ensure that that's not like a lot higher and that's not buried in the TNCs. So these are the few extra things that you should consider when you're investing in a mutual fund, right? Again, I'll pause here for for a question. Yeah.
yeah, there is one more. Do we pick a certain number of stocks and ETFs and keep putting in money on a monthly basis until the goal is reached?
For sure. It also again depends on. So of course, when you start with one or two, right? You keep on adding more and more till you reach a comfortable diversification level of 10 to 20. That's what you do in the beginning. And then once the portfolio reaches a sort of a stable state, that's when you can just keep investing on a monthly basis in those 15 stocks, right? For example. So you start with one, you keep every month just keep on adding one more till you reach a comfortable level of say 10 to 20. Let's for this example, let's take 15. Now, once you've reached this comfortable level, keep investing on these. But then take a quarterly call and reevaluate these stocks just in case, I don't know, you have invested in some risky asset and the company has gone bust or something like very extreme has happened with that company and so on and so forth. So at a probably at a quarterly level, just then keep on reevaluating whatever the companies are there in your portfolio. But yeah, after reaching 15, you can just keep on investing on a monthly SIP basis in those stocks itself.
Thank you. I will
Awesome.
see. Oh, okay. One more. For buying stock, can people from all over the world buy from anywhere? Also, the ETF companies, um, do they work with international investors?
So yeah, the answer is yes. BlackRock, Vanguard, like these are the companies like the biggest name in the world for ETFs, and they almost have ETFs for each and every geography. It depends on your trading platform whether they offer those ETFs or not. Just do a research before you start investing in any platform. Yeah, so first question, yes, you can okay, so let's suppose you're based out of Europe. There are many UCITS ETFs for US. Then there are UCITS China as well. So these ETFs are available. Second question is ETF companies, do they work with international investors? Uh, Not sure how to answer that, but yeah, mostly what like how a BlackRock is structured is they have incorporated subsidiaries in each and every geography, and each and every geography offer their own ETFs, and those could be like Europe geography also offering US ETFs. So those could be cross wherever. Yeah.
Okay. I have personally question like if I invest in stock, and can I protect somehow myself from like today this company becoming bankrupt and stocks just vanishing? Is it possible at least and I just was working the whole day, so I didn't see this new. Is it possible to protect myself somehow?
So one way is, of course, while selection, if you are scared of this, of course, just use those things like okay, high market cap. So first is reduce the probability of such an event happening while the selection with the selection criteria. So invest in bigger companies, safer companies. That's one way. But yeah, on a daily basis, you can subscribe to news for that particular assets on Google. Just like we can have a bookmark. Okay, like if any news related to this particular stock, hit me up with a notification, right? But that again can be overwhelming because Tesla has like 10 notifications in a day. But yeah, like it all depends on how much do you want to sort of do the research. But at the same time, like again, that was a very extreme example of a company going bankrupt. And usually it doesn't happen like in a day or so, right? So yeah, like when you have a list of 15, what you can do is probably weekly just follow on news, anything important that has happened. Do I need to sort of reevaluate? But it depends on how much time that you have to do such things. Yeah.
Yeah, thank you. Okay, let me try sum up everything that we covered today. And yeah,
Yeah.
if there are any other questions, so I would say that the first thing, have this pillow for 3-6 months of your salaries before start any investment. First of all, do this cash like protection for any disaster that can happen in this world. And then if you have it, then well, maybe there one more step like find a job that you love. Maybe invest in yourself first. Invest in your education. Invest in
For sure.
yourself first of all. And when you feel like okay, now I have this pillow and I love what I do every day, like now I can invest money. Um, I would say that think about ETF first of all, right? And think about it like extra pension fund. So actually, if your workplace allow you to put money in pension fund, which also managed by already skilled people who can manage your future investment, that's fine. But even this not an option for everyone sometimes, like not every company advise this. So in this case, like think about it like your pension savings, because it's like, as I understood, it's how the world worked previous 30 years. It was really safe to put money for the long term, like forever actually. Um, and yeah, and then if you're ready to risk, like evaluate your risk appetite, go to some sites, or probably I think we didn't cover, but a lot of people advise to find financial advisor who also can guide you. So probably I mean, of course, you invest to this as well, like to your personal guide, but it also can be a very good strategy to put your money in the ways that they will work for you. And I also would ask if you have any books in mind that you can share, or any YouTube channels, like to make yourself more familiar with the topics. As we covered a lot of things, which is like for a lot of people they're super new. Even for me, a lot of terms they're really new. I do not use them in my daily life.
Sure. So after the session, I can collate a list and share it with you, which we can just post it with the video. So that's not an issue. Just before I go, I think one disclaimer that I need to make is whatever I've went through today is more or less my way of investing. There are like everyone has their own ways of investing. I wanted to make it interactive. I wanted to make it something which you can just like, instead of just imparting theory, something which you can just start and like probably just spare your first $10, $20 to sort of just start with it. And yeah, with time you will also get to know more and more of these terms, and probably just come up with your own methodology to invest. But I just wanted to put it out that this was just the way I invest, and yeah, you can always sort of learn more and invent your own. But I'll also
One
share a
one
few.
question, by the way, do you advise like actually to subscribe maybe to analysts who already do a lot of analytics, and maybe two for diversity again, but like they like, for example, once a month they recommend two stocks to invest in, and you also do your own research, but like it seems like it's a bit easier than do everything by yourself. So like, what do you think about it?
I agree that sometimes it's easier. I think one thing that we should definitely do is never rely on just one advisor. Like whenever you're doing your research, if you heard from one advisor that the stock is doing good, just like corroborate that research. So, like at least in Revolut app, we have a Morningstar research field in which we tell, okay, how many out of like 20 analysts who have given this rating, how many gave positive, how many gave negative. Only when you're sure that like a majority of analysts have given positive, that's when. And after that, of course, do your own research, basic, like does it suit your risk profile, is the market cap big enough, how has the growth been historically. Just do those very basic research yourself before sort of taking in that advice. So uh, in short, do not go behind just one advisor. Just like go with the herd sort of thing, like go with the majority, and then do your own basic research, that is that particular investment suitable for you or not. Very simple.
I want to ask one more important question. How
Yeah.
much time would you advise to spend on all this per year, per month, per week? Like,
I would say, of course, like first priority is your jobs, and like I don't know how much time each and every one has, and then there's no particular prescription to it for sure. It depends also, if you're a passive investor, you're okay just earning the market returns. You don't need to spend more than like, I don't know, 2 hours a quarter, right? You just need to find an ETF and ride along with it. But yeah, if you actually want to dabble into active investing, I would say just make it more of a hobby than sort of doing like taking out 1 hour a week, right? Just with your morning coffee, just like do some news research, like take 10 minutes out, like look at the new news, what's happening in the market. That will keep you abreast, and probably just keep that in the back of your mind, and then probably just block out 1 hour a week to sort of do that research, new research to find new stocks.
Yeah, that makes sense. Thank you so much. Yeah,
Awesome.
let me check. Yeah, I think that's all. Thank you. Thank you so much.
Perfect.
And thanks
Okay,
so much for
awesome.
everyone who joined
Thank you,
us today.
everyone. Thanks for joining. All right.